Hey traders, welcome to Charts and Coffee. Happy Wednesday, everybody. We're taking a look at the pre-market at the moment, 30 minutes before the bell. And keep in mind, we have a couple, three more major hot zones to come this week. And while it's easy to want to reduce the rest of the week to the NVIDIA earnings that'll be coming out at the after the bell today, meaning Thursday will be the first trading session that traders and investors will have to really in mass respond to it. You know, there'll be some reaction, but it'll be after hours. So tomorrow will be the bulk of the reaction. And you know, to see the NASDAQ, to see, say, semiconductors, QQQ, of course, if we're talking about NASDAQ futures as well, and to see the XLK perhaps go into wait and see mode makes a lot of sense because NVIDIA is so heavily weighted in those places. So we have a couple different ways to deal with today, and any day where a high impact, high weighted stock is going to have earnings or any kind of news. You know, we know when Apple's going into some sort of a product announcement. We know that when earnings for any company or even surprise events, when they happen in a high concentration weighted stock, their reverberations are pretty broad. And, you know, obviously NVIDIA is going to have that impact. So then what's a trader to do? Do you have to trade NVIDIA? And the bottom line is you don't. And that's going to take us back to a lot of the positions that we have right now in the sector secrets mastery. How do you trade around an event that you may not have any interest in? I have next to no interest in NVIDIA other than the impact it's going to have broadly in the averages, and I'll deal with that on Friday, right? We'll wait for the dust to settle. It makes a lot of sense to think about managing risk in an event like this. So then, okay, Rag, where is there to trade? Plenty of places. So we know that financials have been moving higher, and financials are weighted heavily in the Dow. They're weighted heavily in the S&P. And while there might be some general risk appetite or risk aversion, I do believe most traders and investors are at least smart enough to know that NVIDIA earnings are not necessarily going to affect JP Morgan. Broader risk appetite and risk aversion can. So let's say you're thinking, all right, Rog, maybe I'll give financials and the S&P a little bit of a break. No problem. Take a look at staples. Staples are absolutely going to give not a hoot about NVIDIA, right? This is Coke. This is Walmart. This is Costco. This is Procter & Gamble. That's another place to go. Another great relative outperforming sector, utilities. And I know we've been talking about these for about 2 months now, but these are the sectors that continue to outperform. So utilities, staples, and another one, spin the gift that keeps on giving, gold, whether that be gold miners to Newmont Mining or the actual gold futures or the ETF to gold miners to NEM. It's really up to you, you know, which way you want to go. I would say keep all three in mind. And those are things we can keep an eye on. You know, the one thing I won't do is indulge in the I'm going to guess which way this moves game. Let everyone else do that. And by the way, whenever you see a lot of traders and investors glom onto a story, and this might sound mean, but this is true. Also remember, the vast majority of traders and investors have no clue what they're doing and lose money. I know, harsh, Rog. That's a truth bomb way too early in the morning, but it is one we all need to think about. Everyone doesn't mean it's right. It just means it's the bulk of the participation. We also know that the typical stats around traders is that 90% of them lose money. So do we ever want to do what everyone else is doing? Unless it's a trend and we're surfing the wave of the trend, probably not, right? So don't be afraid to kind of go your own way, right? A la Fleetwood Mac, and say, hey, you know what? There's better opportunity elsewhere. And for us, that's been the strength in Coke, which we continue to take advantage of. And we're also long GLD. That's a trade that I'll have to close on Friday because I have the August 30 expiring options. All right, so let's Let's go ahead and tackle some questions this morning. Good morning. Good morning. Hey there, David. Good morning. Anyone not in Sector Secret? Oh, thanks, David. I appreciate that. I do. Thank you so much. I have a great team behind me and they make me look very, very good. Yeah. Shout out to the Lorna Bot and the Trish Boss. All right. What about buying puts on DJT? I have not been in any way playing DJT. So, Juan, I try to stick with things that I'm actually doing, trades that I either have on or that I plan on having on. But if you're just looking at it from the sake of the market structure, yes, it has been weak. And regardless of the symbol, any symbol that I'm looking at that has a downtrend would be ripe for long puts, right? But it would need like with any downtrend as well, I need a rally into resistance. That's the trigger, that's the spot, and then I'll take advantage of a long put position. All right. Pat asks, what are we hoping for on PCE? Well, I try to keep my hopes and wishes for birthday cakes, but Pat, I'll tell you what I know we're going to get is potential volatility. But I'll tell you this, Pat, and it's an interesting question you asked. It's what do we expect volatility and where would we expect it? And that would probably land more so on metals like gold, the notes and the bonds, and possibly currencies. The equity markets are pretty well fine, and they've just built it in. They're already moving as if it's happened. And that is the rate cuts are coming on September 18. And so ultimately, the second part of your question is a really interesting one. Is bad news no longer good news? Here's the thing, Pat, and I think the basic answer is this. I don't know of any other answer. We don't know if the Federal Reserve is going to continue to hang on to that data dependence. If they don't want to ditch that language, if they don't want to say, look, we are on a path of normalization. By the way, gang, there's two types of, and this goes right back to the macroeconomics of what is the Federal Reserve going to do. There's only two types of rate cuts. There's the kind where they want to normalize. Things are fine, but it's just time to normalize rates. That's what we have right now. Regardless of all the recession talk that's happening, this is just a vanilla normalization, right? This is not 2019. This is not 2020. This is not an emergency. This is not, the Federal Reserve reacting to a problem, right? Either the one that they created in 2019 or one that was handed to them in 2020. So this is just that vanilla normalization. And in that type of environment, for the most part, and I know some folks might say, Rog, we're in a recession. Here's the thing. Unless the Federal Reserve acknowledges it, their monetary policy won't map to it. So, ditch the world of the real. When we're trading, we are in the matrix with Jerome, right? And if they say there's no recession, their monetary policy is not going to map to it. So this is just a vanilla variety normalization of cutting rates. I would expect the equity markets to continue higher. And therefore, I would expect the bond markets to continue higher, notes, gold, and the euro to continue higher as the US dollar weakens a bit. Now, good news is bad news is Pat will only know if the Federal Reserve either continues the data dependent, which means that every single meeting is a live meeting where they've looked at the previous month or quarter's worth of data and they make a decision, or they're just on a path of a quarter point rate cut every single meeting between now and June, which does seem to be what they're planning on doing. So we really won't know unless they either fully commit to the data dependence once the first rate cut happens or they start to ditch it. And so that's where it's going to be a little tricky. But I will say for inflation, we really want to continue to see cooler inflation to justify the ongoing cut. So I think that might be the easiest one. We want to see flat to cooler inflation. How did the market react to NVIDIA last earnings? JR, don't know. And I mean this respectfully, doesn't matter. This idea that previous earnings dictate the next bit of earnings. Now, if I recall, since you asked, JR, I want to say they've been continuing to beat, but by a smaller and smaller margin. But this notion that the history of earnings is necessarily a predictive data point, I don't believe that metric pans out. Earnings are a response to really two things. One thing, really, we can just say it's one thing. What do we expect and what do we get? And I guess that's where I was getting two things from. What was discounted pre-release and how were those expectations either met or missed. That's it. And in the meantime, there's oftentimes a ramp up into earnings. So if expectations are that they're going to beat, Nvidia will rally into that expectation. So really, the history is irrelevant. It's that whisper number or force rank or expectation versus what we get, and that's it. Now, again, the best window is oftentimes in that ramping up as the expectations are being discounted. So I don't look at the history, but I think I have vaguely recollect the last handful of earnings they beat just marginally. Thoughts on the Apple daily structure? Apple is not in a trend, but it does have green candles, Zach, and I would be a buyer. As long as the candles are green or yellow, I will wait for Apple to sink down into the gray zone, which is a volatility-based support level. I will wait for Apple to sink down into that zone, and at that point, we'll buy calls. Now, notice we haven't really had that opportunity, so I've been leaving Apple alone. And by the way, gang, remember, unless you're dealing with some, monster sized account, we all have to choose where our capital goes, right? And what we trade is more important than how we trade it. So what I do is I compare, Zach, I think about what has a better chance of follow through, Coke or Apple, right? What has a better chance of follow through? And it's clearly Coke. So this is where I'm not bearish Apple, but I've always have to ask myself, why would I trade this in lieu of something else? Why would I trade, another symbol in lieu of the uptrend in gold or in lieu of the uptrend in staples or utilities? Healthcare is another one. So to me, trade this, not that, is always a question we ask, which is rooted in, why does this symbol deserve my money and my attention? It's just really that simple. So it's not that Apple's a bad one. It's not a bad apple. But it is not something at the moment that I have a lot of interest in, because there's other places where I could get better return, if that makes sense. In terms of ZB, ZB is always front running by about 3 to 6 months. So if we take a look at the ZB contract, let's open this up. And this is where TLT is going to move. Notice it's been moving higher since April. So it's not as if the bonds, this is the long bond, by the way, we could do the same thing with the 10-year. It's not as if it hasn't already moved. It has been moving, because it's usually going to front run the monetary policy reality by 3 to 6 months. So now what bonds and notes are thinking about is, where are we going to be by June of next year? And that's the big question mark, right? So bonds have basically rallied into September, and they're holding this area knowing that September 18 is going to be the first rate cut. Right? Bond traders are a very smart bunch, and they're always thinking down the road, way down the road. So the next part of this is, where could we be 3 to 6 months from now? And do bond traders really believe that the Federal Reserve is committed to a quarter point at each meeting between September and June of next year? So I would anticipate more strength in bonds, but let's remember, it's already been pretty darn strong. At this point, it's moved 12 handles since those lows in early May. All right, next up is, what are my thoughts on GEHC? So GEHC, again, going back to, now I'm going to the daily time frame, gang. If you're looking at a different time frame, let me know. I can't make commentary at 8, 9, 14 on a day trade. But if we're looking at a longer term intraday trend, like a 1 hour or a daily or a weekly, let me know what time frame you're looking at. Otherwise, I'll just default to the weekly. It is at least in the bullish side of the hemisphere. It's above the anchored VWAP, so it's at least on the bullish side of things. But as far as a long side breakout, Chris, this is the way I deal with any kind of market where it's stuck in a range or compressed and we're waiting on a breakout. So let me grab my drawing tools here, and I'll show you exactly what we do. And it involves using the automated Darvis. So we look at where things are stuck in here, right? Cut the range in half. That would have us buying in the below the VWAP, which is not a big problem. And then cut that range in half again, right? So what you want to do is either get positions in these two kind of sections of the lower half of the range, right? And then what that does is it gives you an opportunity to at least pay yourself at what we know could be resistance. So that would be sort of the first leg of the trade. The second leg of the trade would be that momentum breakout. I'm not a momentum breakout trader. I find it a very low probability way to go about trading as compared to buying into support. And that's the way I would treat anything that could break out. Now, you might say, Rog, what if we don't get down that low? Well, you could also look at it from this perspective and then cut this zone in half. And that would be the top of the Darvis to the anchored VWAP, right? That would be that zone. And if, again, you want to build something in the lower quarter or the lower half of the range, at least gives you the opportunity to pay yourself here about 86. And if we break out through 86, you could already be in a position where you've got a realized profit. You can move to break even. And then the second push, if it does end up organizing into a Momo breakout, you've still got skin in the game, but you've managed your risk, right? And that's always what we'll optimize for, managing risk. And managing risk really should be considered what's the only path that I've ever found that scales to account growth. It's always risk management. It's always, most people think account growth is winning trades. But on the flip side of winning trades, if we're not managing losers and if we're not managing the winners, there's no account growth. I hear a lot of traders, when they describe their P&L, it looks like a roller coaster, right? That's a tough way to go. We want boring, right? We want boring, sometimes quiet. Yeah, sometimes we'll get a drawdown, but this is what we're looking to do, right? And this is managing risk, right? And that's the only path to account growth that I have found in 30 years. The holy grail is position sizing and risk management. And so that strategy is another way of living that truth, which is, how do I manage risk? How do I account for maybe the market getting stuck at 86 and not letting a buy at 86 turn into a loss versus a buy, say, at 82 and a half or even 83 and 3/4, giving me the opportunity to at least pay myself and manage risk. So different way of looking at it, but it does really work well. And if you think about it, yeah, Rog, if I think about the momentum breakout as a second leg, I can be in a much better position for that first leg. All right. Next up is, what do I think about the outlook after rate cuts? Many articles historically market dropping after a rate cut. It depends. It depends on your time horizon. Is it a 1 month study? Is it a 3 month study? Is it a 6 month? Is it 12? And please remember, and again, no disrespect to people writing articles, but they're not traders, are they? So always think about, is this someone who's been in the market for decades, talking their book, talking how they managed this in the past? Or is it someone writing an article who has no idea what it's like to be a trader or, frankly, an active investor, right? So two things. One, what does the article say? Is it 1 month, 3 months, 12 months from now? And what type of rate cut, right? 19 and 20 were different types of rate cuts. Those were emergency monetary policy adjustments for various reasons. This is not that, right? This is absolutely not that. So it depends on the type of rate cut. There's really two kinds of cycles we engage in as the Federal Reserve is either dealing with a problem or just trying to normalize rates. And then what's the time horizon? I'll tell you, the much more interesting factor was that VIX spike we saw with the carry unwind and the Japanese yen 5 standard deviation move. I can tell you this, after the VIX typically exceeds 30, 32, 12 months forward, usually equity markets are up. So, again, I don't want to compartmentalize and get lazy about, well, if this happens, then this. As one of my early senseis when I was studying martial arts said, never expect an anatomical response. You've always got to see what you're doing and what reaction it actually does elicit. Yeah. So I know we always want to compartmentalize things because it's convenient and it's helpful and we love the generalizations, but I wish it was just that easy. I am going to remain bullish as long as the sector performance is encouraging, especially for the S&P and the Dow, with strength in healthcare, strength in financials, staples and defensives like the utilities make sense. And let's see what NVIDIA brings us, because that might just wake up the rest of the market, or it may not. And if it doesn't, who cares? Our life is so much bigger than tech stocks, isn't it? And if it's not, it needs to be, because there are sectors and there are stocks on the move. They just may not be the ones everyone's talking about. All right. Okay, gang. I'll see y'all in Charts and Coffee tomorrow. Be good to each other. Till then.